One of the things that we've done recently that I think is just fascinating is to examine the world through the lens of clairvoyance. Now, what is clairvoyance? It's seeing the future. Some years ago, 2009, we looked at clairvoyant value. What if you could see future distributions of stocks and their endpoint share price 10 years, 20 years hence, or even further out into the future, and discount that back? If you could see that, how would you value the company, and how does that compare with the current value? If value equals price, then what discount rate would you have to use for value to equal price? So if a clairvoyant could see the future and thought the price was fair, what discount rate would they have to use to consider the price fair? What was fascinating to us that has a direct bearing on this whole debate about market efficiency is that the average growth stock, most of the time, is priced to have a clairvoyant discount rate, at least over the last 50 years, that is less than the yield on Treasury bonds, often less than the yield on Treasury bills. And so if the average growth stock is priced to give a forward-looking internal rate of return lower than bonds and even lower than cash, well, what does that say about market efficiency? This work on clairvoyance does really call into question the whole issue of market efficiency, because how can any stock be priced at a discount rate that's less than bond yields or Treasury bill yields? To be sure, a stock can disappoint, but an entire class of stocks, all growth stocks, on average below T-bills, that seems odd. Well, what this means for investors is something very straightforward, and that is that growth stocks win only as a consequence of outliers. The portfolio return beats bonds or beats cash only if there are some home runs. The average growth stock doesn't win. The other surprise in our research is that the small cap effect disappears, evaporates completely. The average small cap stock has a clairvoyant value, a clairvoyant discount rate, I should say, that's lower than the clairvoyant discount rate for large cap stocks. Well, that's interesting. What happened to the small cap effect? The small cap effect works at the portfolio level because a portfolio of small cap stocks has some big outliers, some home runs, which means that the small cap effect works because of the home runs. You have to have that diversified portfolio. You have to not miss the home runs in order to have a winning small cap portfolio. The same holds doubly true of growth portfolios. Not only do you have to include the home runs, you also have to cherry pick and avoid a large number of moderately disappointing growth stocks that are priced for superior growth that doesn't in fact materialize. So this has some really serious lessons for investors who want to anchor on the notion of market efficiency. Bottom line is simple. Growth stocks are priced to offer a lesser risk premium than value stocks. Makes sense. They're seen as less risky. They're seen as more comfortable, so they ought to give you a lower risk premium. But the average growth stock is actually priced to give you a negative risk premium. So you actually need home runs just to get a positive risk premium at all. The point here is that the safer approach is to simply accept the notion that value investing does, on average, win over time. That investing in the segments of the market that don't require home runs wins over time. That investing in companies with a lot of sales, a lot of profits, a lot of book value, a lot of dividends really does make the most sense.